So what do you look for when you are presented with a company that potentially is an investment candidate or a purchase candidate for you?
When we're looking to acquire a business, we're looking at
Andrew Dumont, founder and CEO at Curious.
What can we do strategically to either recap this so the incentives are aligned? Because that's one of the core things that we see is that the incentives of the founders, the investors, if they've taken on debt, etc., they aren't aligned necessarily to build a long-standing business. So our main goal and our main value in a lot of these is recapping them with the intention of long-term operation and long-term profitability and sustainability. So that's really the main thing that we're looking for, do they have a path to that? And do we believe in that path? And do we fundamentally believe that we can help them along that journey?
Hey, Andrew, how are you?
I'm good. Good to see you, Dan.
You too. Good to catch up. So I met you last year, about 7 months ago. You posted on LinkedIn that you are helping distressed startups. And I read it was an excellent post. And I thought to myself, I got to meet this guy because you are in the world where I've made a living for the last 20 some odd years. And I want to talk to you about that today for sure. Before we dive right into that current world, I'd love to understand a little bit about where you come from, your journey, how'd you get here, what's going on? Talk to me.
Yeah. I mean, I got involved early in my life in early stage startups. Got involved with my first one when I was a teenager and kind of fell in love with it ever since that. Most of my experience had been in venture-backed startups, companies like Bitly, Moz. I was at a firm called Betaworks in New York City where we worked on Giphy and Instapaper and a bunch of these great companies. And I just spent most of my time in kind of this run fast as quickly as you can and build as big of a business as you can type world. And, it got to the point where 15 years in or so, I kind of stepped back and I said, man, like as good of outcomes as this can create, it can create a lot of bad habits as well, and it can kill a lot of businesses as well through that process. So that was kind of a pivot point in my career, and that took me to a firm called Tiny, which kind of bought these earlier stage kind of subscale software businesses, internet businesses, and I was the CEO for 3 other companies that they acquired. And then I recently stepped out and founded a firm called Curious, which is built to really acquire and kind of recap these venture businesses that aren't really venture scale anymore, aren't really built for that. And that's what we're working on. So excited to dig into it.
Yeah, I'd like to go back. You said you had a startup when you were 15. What'd you do?
Yeah, well, teenager. It was a company called Tatango. It was actually a group text messaging startup before there was GroupMe and all those companies. So it was we raised a small angel round and just totally cut my teeth on things. So it was a blast.
So how do you legally do that when you're not old enough to sign a contract?
Yeah, it's a good question. I think our CEO was a little bit older than me, not by much, a couple of years. So we made it work. I don't know why they gave us money, to be honest, but in hindsight, worked out. Everybody was happy, and it was a great experience for me, obviously.
That's awesome. High school kid, and you got a business that you got angel funding for. And
pretty cool.
Yeah. It's cool.
Embarrassing photos I can share later of that time, but that's another story.
Yeah. So you're in a world where you buy distressed companies, and you probably start to see a pattern as to why they become distressed. First of all, what is, in your definition, a distressed startup, and how do they get fucked up like this?
Yeah, it's funny. Like, we had a journal piece that came out with the fund announcement and what we were doing, and they really leaned on that distressed term. And I don't view these businesses as distressed, and there's varying levels of that. I think they are considered distressed, at least in the way that we would talk about it, in that maybe they're not profitable. And they are not able to raise their next round, which puts them in a difficult position, right? Where they're not fully sustainable as they are operating today. So that's what we're seeing a lot of, and that's really what we're trying to jump in and help find an alternate path for, create an alternate path for. So that's typically what they look like. I'd raise a seed or Series A, got to a certain level of scale, and then they just became not interesting enough for venture capitalists. I think that's really the key thing to focus on here is like, what is interesting enough for a venture capitalist to continue to invest in a business? And at the early stage, there's nothing really to point to when you're investing seed or pre-seed. It's really just a concept and a team. But then when you get to Series A or you get to kind of later seed, you need to show some stuff. You need to show incredible growth rates, right? At that size, like you're talking 100+% year over year in terms of either user growth, revenue growth, etc. Right? So the bar becomes really, really high, and especially given the time that we're in right now, where interest rates have made money more expensive, the bar is even higher now. So I think that's really what we're seeing is like the goalposts keep getting moved out for these founders on like what makes them venture backable. And a lot of companies and founders are kind of running into the reality of that.
Yeah, I see it every day. I talk to a lot of founders and they all are talking about doing a safe. Everybody wants to do a safe. What would be your advice to a founder who's saying that to themselves?
Well, I think the investment vehicle or in terms of that is more secondary to a lot of these founders raised a bridge round. I actually wrote a post about this on our site, speaking to 2023 was really a year where a lot of these bridge rounds were getting done, which was basically like, hey, here's more time. It's not a lot of time, but here's more time. And investors were signing up for that. But once that time runs out, they're not able to get that next bridge. And that's where they're kind of running out of options there or running out of good options there. So I'm just seeing less willingness to bridge any further than they already have.
So along my journey, what I've seen is I'm the guy that gets the call to come in and from a go-to-market standpoint, take them to the next level, which is really to rescue them from themselves. And when I come in, I see all the same stuff. They grew too fast, hiring an army of the wrong people, sales reps, BDRs, SDRs, whatever you want to call them, marketing people, and they just can't get it together. And leadership doesn't really know what they're doing. And it makes it very difficult for the founder when the investor / VC board member says you need to move extremely fast and generate X amount of dollars top line revenue by 2 years from now. I don't think that's what the founder had in mind when they started the company. They figured, hey, you know what I'm going to do? I'm going to go build a company that actually solves a problem and is doing the right thing. I'm going to employ a bunch of people, and that's my goal. And all of a sudden, their goal changes because they have a different objective than their investors and board members, and that's where the disconnect happens right out of the gate. Does that ring true to you? Do you see it differently? And if so, get any examples of where that happened? Don't necessarily use company names because I don't want to.
Yeah. I mean, I think that's a fundamental challenge, and I think the thing to acknowledge about that is it is from all of my experience that I had operating early stage companies, it is remarkably difficult to get from 0 to 1 million to 5 million to 10 million. That's an extremely challenging thing to do. It's much easier when you obviously have a business that is real revenue, has real product market fit. And you're essentially asking these businesses pre-product market fit to run really fast and grow really fast, right? While also trying to find product market fit. It's an exceptionally hard thing to do. So I think just the reality of that is it's just difficult. Venture capitalists need it to go fast and they need it to go well. Like these businesses or these founders that have started these businesses as product people looking to solve a problem, they're now asked to be revenue people and marketing people and salespeople. And a lot of them, that's not really what they got into it to do, but it's necessary, obviously, to do. So it's just one of the fundamental things. And I think the recent trend actually that's making that even more complicated is they're asked to build a venture scale or venture growth business while also having a path to profitability or sustainability. So you're asking these businesses to be both venture growth and profitable at the same time, which makes that even harder, obviously. So yeah, it's just a fundamental challenge. It's extremely difficult.
So what do you look for, Andrew, when you are presented with a company that potentially is an investment candidate or a purchase candidate for you? And I understand, as I know your business, you do both, or you can do both. Outright purchase a company and run it, kind of like private equity, or also just invest in it and help it, kind of like venture.
Yeah, that's right. Yeah, I mean, we have 20 plus now pre-seed investments that we've made. And the new vehicle and new thing that we've built is actually more of an acquisition vehicle to help support these distressed venture companies that aren't able to get to that next stage. So on the pre-seed side, it's a very different evaluation mechanism. When we're looking to acquire a business, we're looking at what can we do strategically to either recap this so the incentives are aligned, because that's one of the core things that we see is that the incentives of the founders, the investors, if they've taken on debt, etc., they aren't aligned necessarily to build a long-standing business. So our main goal and our main value in a lot of these is recapping them with the intention of long-term operation and long-term profitability and sustainability. So that's really the main thing that we're looking for, do they have a path to that? And do we believe in that path? And do we fundamentally believe that we can help them along that journey?
So you probably got a million war stories.
Yeah, I mean, I have a ton from operating, obviously.
Give me one or two here, because this whole story thing is just so interesting. And quite frankly, any founder that listens to this podcast, I would love for them to take away some words of wisdom from Andrew as to, here's what to avoid.
Which kind of story do you want? We could go in all sorts of ways. Yeah. I won't mention like the name of the companies. Yeah. Or the name of the company, but there's been several examples where, we had taken on both venture capital and we had taken on debt. So not only were we trying to solve the venture capitalist goals in terms of the growth of the business and that sort of trajectory, but we also had covenants in our debt that made it so we had to have a certain level of profitability or earnings with that business. And if we didn't, we would essentially get called on our debt and have to essentially accelerate that and pay that back, or they could take action against us. So I've had several operating experiences where both of those challenges have kind of been altering the way that we thought about operating the business. So you have all these different masters essentially that you're trying to serve through this, and it's really difficult. And I think just looking at the number, we've probably looked now at 100 businesses. There's a lot of companies that are venture backed that are in that state right now. And it's just impossible to be a good operator in that. It's really, really, really difficult to try to solve all of that. So, I could go deeper on that, obviously. But yeah, I mean, those sorts of environments, I think, are just really, really challenging.
So when you were an operator, what kind of mistakes did you make that you look back and you're like, ooh, I really messed that up?
Yeah. All sorts, obviously. I think when I look back in the difference between operating with Tiny when I was a CEO of their businesses, which are similar in that they are profitable and sustainable, the decisions that I made and the way that I operated versus venture-backed, it was just such a better decision-making cadence for me because we weren't desperate, and if you talk to all these CEOs, and Dan, I'm sure you've worked with them as well, it's a shiny object syndrome. It's just, they won't stick to a path. So, and that's not because they're bad people or they have a hard time focusing or any of that. It's because they are constantly pulled around based on incentives and what they're asked to do. And I think the biggest thing for me in terms of the shifting of the way that I think is calm environments and being deliberate and picking a plan and sticking to it. Sure, you can pivot within that, but as I've operated more, I've focused more on what is the end state we're trying to get to and focusing on the plan and sticking to the plan as opposed to having the shiny object thing, which is, I think, all too common, really, in this.
It's funny you say shiny object. I refer to it as shiny penny syndrome, because you pick up a shiny penny when you see it, and then you pick up another one when you see it, and you pick up another one when you see it, and then before you know it, you got 20 shiny pennies.
Then you realize they're just pennies, right?
What can you do today with 20 shiny pennies?
That's right.
Funny story.
That's right.
I went out to ice cream with my family the other night, and we're standing in line, and the line gets where I'm now in the actual ice cream store as opposed to outside the store. And I look on the ground in front of me, and there's a shiny penny. So I took a picture of it. I zoomed in, and I took a picture of the shiny penny for the purposes of this conversation. And my son looks at me and he's like, "Dad, what are you doing?" I'm like, "Took a picture of the penny." He's like, "Why?" And then I'm thinking, how do I tell a 13-year-old and give him an explanation of this example of, venture-backed businesses and lack of focus? And I did my best. And at the end of my, rant, he looks at me, he's like, "Yeah, whatever." And then puts his headphones back on and listens to his music. But it happens a lot. We also refer to it as kiddie soccer, where wherever the ball goes, everybody's running after the ball, and it just becomes a disaster. So your advice to a founder is stick to your focus. Definitely look at the shiny pennies, but you don't necessarily have to pick them all up.
Yeah, I mean, it's flailing, really, is what that is. It's flailing because you're not confident in, or you're not getting immediate feedback that what you're doing is working at the level that you need it to work. That's where that's coming from. I think that's really it's okay to take that data and interpret it and see if it alters the plan, but you need to have belief in your approach and your vision and the end state that you're skating towards, and staying on that path, as opposed to getting distracted by the shiny pennies or whatever it is. It's flailing, and your team feels it too, just as an operator, speaking from that perspective. The biggest feedback I hear from team members within venture-backed businesses is that nobody sticks to the plan. Like, nobody stays on the same vision for long enough to actually realize it. And that movement within or outside of that creates a lot of fatigue within teams. And it prevents people from doing their best work, from my view.
So I came through the ranks as a sales rep, and then to a sales manager, and then CRO eventually. One of the things that I saw, especially at big companies, I'm not going to name which ones, but it happened multiple times for me. Your manager would come in and say, "Okay, Dan, I need you to go in this direction." And you'd go in that direction, and you'd, over months and months start working. Maybe it's a vertical or a geographic territory or whatever it was. And you busted your ass to make some traction there. And then the next thing you know, you're told, "Well, actually, don't go right anymore. Go left. We need you to go over here." And you're thinking, "All right, my boss told me I got to switch. Okay, so we're going to pivot." And then you pivot, and you do this over and over again. And eventually 2-3 years into it, I'm like, I'm not making any freaking progress. I'm not making any money. And they're looking at me wondering, why aren't I hitting my number? Well, the answer is you keep moving the goalpost on me and changing the goals. Well, that being the case, I can't do it. And you know what? You leave. Now the company suffers because the cost of finding a replacement is ridiculously high, as well as the time that you lost in productivity. I'm sure you've seen this too. Any examples you can share there? You've had multiple areas, obviously.
I obviously worked as a CMO at Bitly and a number of other companies. So I have it from the marketing lens, but it's the same thing, right? And that's probably the most common thing you hear with marketing functions or marketing as a channel, is that the CEO will say, "I want to grow faster." They give you maybe a little bit of budget, and they expect customers to show up a month from then, or 2 months from that, and 3 months from that, max. Then once you get beyond that, patience starts fading, and the commitment goes away, right? Because they need immediate results. And if they don't see that, they can't continue to invest in it. And that causes a flailing, right? And I think it begs a question, well, why do all these really smart people have that tendency to move around so much? And it really comes back to, if I have 12 months of runway as a founder, right? 9 months of runway as a founder, and I spend 3 of them on marketing or sales without immediate revenue generated from that within that period, can I really commit another 6 months when I only have 9 months of runway to continue down that path if I don't see the ROI? The answer is it's hard to do that. So that's really where it's coming from. It's not because they're not smart people. They always are, almost uniformly, if they're founding a business and have any success of any kind. So it goes back to that incentive structure and the way that they have to make decisions with the timeline that they're working on and the expectations that they have.
But then you'll hear the mantra, fail fast.
Yeah.
So how do you justify the world is telling you to fail quickly and pivot, and you're thinking, well, wait a second, I got to deal with my runway. These are tough decisions that founders have to make, So you've had multiple exits. I was looking at your LinkedIn. I saw 4. There's probably more. Love it. Congratulations. It's great to exit. What's the one thing in common among these companies? What is it exiting is hard. And sometimes you do it by accident, and they're not always good exits. However, it's a success when somebody wants to purchase you for positive reasons. What are these companies doing well?
Man, well, I will say exits aren't always a good thing. And that's both in the outcome of the investment in terms of price and structure and all those things, but also, I think with exception to one of those businesses, every other one of those exits, they ended up shutting down the business. So for me, yes, there was some outcome at an exit, but that business isn't around anymore, and I put my heart and soul into that for many years. And that's true of anybody that has started a company, sold it, and it ended up getting shuttered, which is the predominant story when it comes to acquisitions, especially when it's acquired by a larger company, because it typically doesn't make sense to continue operating that business. So, that's sad to me. Like, that's actually one of the things, the core things behind what we're doing is that we are building with the intention of not shutting these businesses down ever or exiting them again. So that's like a key distinction that is stemming from that experience. But in terms of what made those companies exitable, it's typically a certain level of product market fit, either in user data or in revenue data, right? Those are the ways to measure product market fit. The second component, because most of them were strategic acquisitions, was just right timing, right? Right space, right point solution that we had built. And strategically, it was something that they were looking at and wanted a piece of. So there's a lot of luck involved with exits, as well as macro environment. Are companies acquisitive during that time versus now? Like, there's not as many transactions happening these days. So timing and luck has a huge piece of it. But I would say overwhelmingly, the thing has been obvious product market fit, either on a revenue perspective or a user perspective.
So I'm going to switch gears on you and talk about people, because I believe that a company's biggest, I don't want to call it an asset, because then you would say people are assets. They're not. They're, but people are really, really important. What do you stay away from when you're looking at a company, or for that matter, as a leader, when you're hiring people? What kinds of people qualities, issues do you look for? Do you stay away from?
I stay away from entitlement.
How do you find out if somebody is that way? What are you looking for?
Yeah, I mean, I think people's willingness to do things that are maybe outside of their job description or a very narrow focus typically speaks pretty well to entitlement. Through my entire career right now, and I'm very much in the weeds, like I do things that someone with 20 years of experience would typically put their nose up to. I try to never do that, and I hope to never do that. And I think that speaks to just a willingness to do what needs to be done to help the business or help whatever vision that you're working towards. So I try to sniff out entitlement as quickly as I can with folks.
That's a big one. I have a saying that I share with the team all the time, which is if I ask, we got to dig a hole, I got a shovel in my hand. But guess what? I also have a clipboard. So I'm holding both. But I'm going to get in there with you. But at the end of the day, I do have the clipboard. And people appreciate that for sure. So entitlement is one. What are some other things that you run for the hills on? And when you're looking for, when you look for companies to invest or purchase, what do you run away from? People-wise.
Honestly, man, I have the entitlement one is just like a good functional thing to pay attention to. At the end of the day, I want to work with good people who are like good, genuine people and are morally sound, showing up for the right reasons, self-motivated, all those things. Like at the end of the day, I want to work with good people. So for me, you can teach people a lot of stuff. If they are self-motivated, if they are willing to learn, and they are good people with moral ground, you can do a lot with people like that. And that really is the most important thing, I think, to building a good culture, is having great people that other people want to be around. So, at the end of the day, I know it sounds simplistic, but that's really what you're looking for. Obviously, there's functional expertise that you weigh, but at the end of the day, that's the thing that I look most for. And that's true with companies that we either invest in or buy. I mean, it's the most important thing.
Yeah, people is a big topic these days. What do you do with the resident asshole who's brilliant? What do they call that? There's a term for it that like the brilliant asshole in the company who's so freaking smart and valuable, but at the same time rubs everybody the wrong way. Ever seen any of those people?
Yeah, for sure. I mean, I think it's important to draw a distinction between an asshole and someone who is opinionated and speaks freely and works to remove bureaucracy, which by some people can be taken as like an asshole thing. So there's a very fine line there, but I think it's an important line to draw. For the person that is blatantly disrespectful and an asshole, I don't think there's any place for that. For the people that are intelligent and pressing forward in a intentional sort of way, which can rub people wrong, I think that's a good thing. And I really, people that have worked with me in the past, I'm sure some would say that I can be an asshole sometimes. Because I am very direct. I try not to care too much about bureaucracy and playing nice and sandwiching things. Like, I want to speak to what we're talking about. So I think it's a fine line, and that's like a personal thing for me. Like, just because I see myself a little bit on that line, and I kind of live there a little bit, to be honest with you.
Yeah, sometimes you got to do some of the tough stuff. I was told by a manager once that I had to tell one of my reports that their perfume was too strong and it was offensive to everybody in the office.
Okay.
Fucking brutal. It was one of the worst conversations I have ever had, but I had to do it, and this person didn't take too kindly about it. And I became an asshole. And sometimes, hey, man, these things happen. Ever had to do anything like that?
You know, not a perfume example, but I think it's so many people that have either worked at maybe big companies. They're used to bureaucracy. They're used to the meeting for the meeting before the meeting. So when you're breaking bureaucracy and um, the inherent nature to go down that path, it can feel very abrupt for folks. So for me, that's what it has shown up is getting to decisions and being direct on those things and kind of removing the bureaucratic process. That's I haven't had the perfume example on my side yet.
Hopefully you never will.
Yeah, hopefully not.
So we talked earlier about the world of the VC in the past was not aligned with the world of the founder. And the VC's coming in saying, run, run, run as fast as you can. And you've made a living, and I've made a living, as I started the conversation, doing that. How are things changing, in your opinion? How are the VCs changing their game? And how are founders starting to realize that I need alignment with my investors? I need to make sure that we're all on the same page here so that we're not picking up shiny pennies or looking for the shiny object. We are focused and we're all aligned to do the same thing. Talk to me about what your opinion is and what you're seeing in the market with regard to that concept.
I mentioned this in another conversation, but I think that there's just more awareness of how VCs are motivated and what their business is. There's more awareness of the power law that exists within venture capital and the implications of that in terms of the type of businesses that need to exist in those venture portfolios. And it creates this very binary, you're a massive winner or you're a loser sort of dichotomy within a portfolio, right? So I think more second, third time founders are more reluctant when it comes to taking venture capital because of that. And as much good can come out of that in terms of building exceptional businesses, it also lights a lot of companies on fire and burns them down because that power law requires exceptional outcomes, 100x type outcomes. So I think there's just more awareness of that, which I think is just such a good thing because I just want to be clear, like it doesn't mean that venture capital doesn't have a place and isn't a good vehicle, but it does mean that I would argue the majority of startups actually shouldn't go down that path in terms of raising capital in that way because of the incentive structure that it creates. Just a quick comment. I don't know the term for it. I came across it the other day, but I'm seeing more founders as well start doing this one and done fundraise, where they're raising an initial seed round and then essentially trying to get to profitable, sustainable operations. And investors are aligned with or not aligned with that approach, which I think is also another compelling path here if the incentive structure is kind of set in that way from the beginning. So for me, or what I would take from that is awareness and kind of morphing of and playing with the traditional venture model, which is, I think, happening now.
Look, there's a lot of really smart people on both sides of the equation, and the market is dictating that we need to change the way we approach the whole startup world. And now you're seeing it with AIs. It costs nothing to start. Well, it costs a lot less to start a company today than it ever has. And so, especially with AI and all these AI companies that are popping up all over the place. And I think bootstrapping is like the cool thing to do, and if you can do it. But even, what would be your advice to a founder that's just got a great idea that wants to get rolling? How would you grow the company over the long haul? What would your recipe be? I know it's not
over the long haul.
Over the long haul, how would you approach it?
Yeah, I mean, I think just if you're talking about founder outcomes, the best possible outcome for a founder is to bootstrap a business, if you can. And there's all sorts of personal and all sorts of challenges that come with that. But when you're speaking purely to what creates the best outcomes in terms of autonomy and financial outcomes, I think bootstrapping is the obvious winner there if you can do it and reach scale. There's obviously exceptional outcomes in venture-backed businesses as well. But it's just so, like to your point, Dan, it's so efficient to create a business today. And if you look at what we're talking about with software businesses, traditionally, they are almost uniformly greater than 80% gross margin businesses on kind of the worst case type thing. So you're taking these exceptionally efficient businesses, that is software, and somehow we've turned them into these like cash burners. And it's because so much money is going towards super highly compensated people and marketing spend, and sales spend, et cetera, because they're trying to grow as fast as humanly possible. So I think if you just simplify it back to like, hey, if I'm running this as a logical person, like I'm spending the amount of marketing dollars that produce the corresponding amount of revenue, right? Like just very simply, like that's what I'm trying to do. In marketing, that's the CAC to LTV type ratio. Like you should be right at parity there, basically. So so I think it's just getting back to the fundamentals of like, what does a sustainable business look like? And the beauty is within software is you have so much margin to play with in these companies, and I think that we've forgotten that in a lot of ways.
I've got a client that I advise for right now. He's awesome, super smart guy. He's from the Middle East. He's bootstrapping. He built an AI platform that is spectacular, and he's doing it on $6,000 a month. And he's got a whole dev team that he's hired from the Middle East. So they work almost 24 hours a day, 7 days a week. And they're excellent, but he doesn't have to pay them anywhere near the amount of money that he would have to pay a team here in the US. So he's offshored his dev. He's doing all founder-led sales right now. He's doing extremely well in to your point earlier, very focused niche in the go-to-market world. In his ICP is very focused in banks. He is going after banks. He goes to one bank, he gets a deal, and then he takes the fact that he got that deal to a competitor and says, I'm working with these guys over across the street. Here's the outcome that they're seeing without giving away any confidential information. And then he gets that second bank, and then he gets that third bank, and he's still only spending $6,000 a month. So now he's got a profitable company. So now the question is, and he's trying to figure it out, do I go and do a safe and get some money so that I can grow even faster, or do I continue at this pace? And my advice to him was, well, it depends on your end goal. Do you want your goal to be 6 months from now, or do you want your goal to be 2 years from now? And that's a decision that he's got to figure out. And these are hard decisions, and I'm sure these founders are up at night, trying to come up with an answer to. But he doesn't employ a whole heck of a lot of people. And then he's thinking, well, I need more people, but because he's in the AI space, he's using AI to do the job of people. This guy, he's a young guy. He's brilliant. And I'm really psyched and proud of him because he's figured out how to do it in the year 2024 using 2024 technology.
Well, I think you bring up an important point there, which is what's your end goal? And what do you want your life to look like, really, fundamentally? It's after looking at as many of these venture-backed businesses as I have at this point, you see two things. You see, one, that they are grossly mismanaged from a spend perspective, either in people costs, marketing costs, just costs generally, like how they're spending money. And I would argue it's the result not of the need, but of how many dollars they have in their bank account. So if you have $3 million sitting in your bank account, you're going to be a lot less stringent when it comes to the use of those funds and intelligent with like how to make the most out of them, right? So that's point number one. Point number two is some founders want to build a rocket ship that is a $1 billion plus outcome, and that's why they got into entrepreneurship. There's a category of people that like, if it's not going to be a $1 billion business, I'm not that interested. I was never one of those people, but some people are. And that's great. Like, you should go raise venture capital, honestly, because that gives you the best chance of reaching that outcome. But a lot of other people, they want to build a good business and they want to solve the problem that they set out to solve. And in that case, there's a bunch of ways to skin that cat and back that business. Like in that example you mentioned, he can continue bootstrapping. He could go do revenue financing, right? Take out like revenue-based financing. He could take out a small business loan. He could raise venture capital. Like, he can do a bunch of stuff in terms of capitalizing that. And it all goes back to, what's your goal?
Yep. It's there's not a shortage of opportunity. There's not a shortage of approaches to recognize your dream, but I think it's key that you make sure that you recognize your dream. Hey, this has been a really fun conversation, Andrew. I appreciate it. Love your input and your perspective for sure. I would ask, how do people get a hold of you? What's the best way to reach out to Andrew Dumont?
I'm hello@andrewdumont.me. So that's my email. And then the curious side is curious.vc. And I'm pretty easy to find. So feel free to reach out to me.
Awesome. Great stuff. I love that you're helping companies get out there and maybe take what was a very difficult, almost end for them, and they got a new life. You're bringing a new life to a lot of people. Good for you, man.
That's a hope. Well, I appreciate it, Dan.
It's all good. Thanks. Good to talk to you.